Looking at the next slide, what you'll notice here is that there are a number of different types of private debt. These vary from unsecured to various kinds of property lending and even lending against business cash flows. In the early days of private debt for us at TAMIM, we ran a number of closed-ended funds which focused on unsecured lending, and that, while it was very successful, was definitely a good education for us. And we quickly learned that bizarrely you could actually get better rates on loans which were secured rather than unsecured. What we also learned at the same time was that in Australia, the level of protection given to lenders in an unsecured transaction was really poor. In our due diligence over some of the underlying loan portfolios, quite often what we noticed within these unsecured loan platforms and lending managers was that the credit work done tended to be quite systematic and actually was quite substandard. For example, the one time myself and Jeff were out at a manager and we'd actually seen borrowers being granted loans when actually they should never have been given these loans. A simple review of their bank statements indicating deposits into gambling or betting accounts. So to us, that was a massive red flag. And the other key thing that we picked up there on the unsecured lending businesses was on the recovery side, given that the loans written were generally pretty small in size. When a loan went bad, it was normal that they actually were it was too expensive to recover against that loan through a legal channel. So quite often what you'd find was the lending managers would sell those loans to other parties at 30 cents on the dollar and recover as much as they could. So with all of that said, today we tend to stay very far away from unsecured lending. It makes a lot more sense to us to go into the secured space where we actually generally get a better return. With lending, which is secured by property, we find we're able to tailor strong security around the loans with loan to value ratios typically around about 60%. And there's a good legal system in Australia which allows you to take ownership of property security if the borrower tends to default. Interestingly, we also find some good loan portfolios which focus on business cash flow lending. One of the good examples to give here is in one of the loan portfolios which we've invested into. That portfolio had historically lent funds to a recycling business which had a number of contracts with local councils for recycling. That particular business had actually gone to the banks and looked to try and actually get that loan funded by or within a banking environment. But the banks, when they looked at their checklists, one of the key things that the banks were saying is the business had to be in operation for more than 2 years before they'd lend to them. And in this instance, the actual new company had only been operating for just over 12 months. So despite the fact that the operators of this business had run it in a different format historically for years previously, and despite the fact that they had 5-year locked-in contracts from local government bodies, the banks wouldn't lend to it, wouldn't actually go through with the loans to them. So the private debt parties stepped in and took advantage of this, lending funds to the business. And I don't really need to tell you the loans never missed a payment, were repaid on time at the end of the loan period. And as investors into that platform, we generated some good returns out of that.